The Peter Schiff Show.
Well, the bear market in global stocks continues. In fact, I believe we're in a bear market in the United States, even though nobody wants to admit it's a bear market, because technically the major averages are not quite down 20%, even though some of the averages are. You know, the transports this morning were down 30% from their highs. Clearly bear market territory there. The Russell 2000 down 25%, better than 25% from its high. That's a bear market. There are many individual sectors that are way down in bear market territory. And of course, individual stocks. Look at IBM today hitting a new 6-year low. The stock was down about 6 or 7% on the day. And of course, that's the poster boy for share buybacks. Imagine how much shareholder money has been flushed down the toilet buying back stock at over $200 a share, and now you're looking at $120 and falling. But remember, all bear markets begin as corrections, right? I mean, you can't be down 20% unless you're down 10% first, right? You're there. The bear market of 2001, when the S&P and the Dow were basically cut in half and the NASDAQ went down by 80%, that decline started as a correction. Same thing in 2008, that market meltdown where the S&P and Dow were down by about 50%. They were calling that a correction too, until they realized that it was a bear market. And that's what they're talking about today. As it's a correction. In fact, the main thing they're talking about today on CNBC, the way they cover it, is the comeback. The fact that the Dow had this huge comeback because, it was down better than 560 points at the low, and it closed down just 249. What a great comeback, right? The NASDAQ was down better than 160, and it only closed down 5. So, hey, everything is great. No need to worry because we had this great comeback. If we hadn't had the great comeback, had we closed on the lows, had we been down 1,000 points today, maybe we'd be closer to a short-term bottom, maybe a final capitulation. Maybe if we gapped down big again the following day and then had a real reversal where we closed positive, then technically you'd have something to hang your hat on. But to me, this is the same old, same old. This is another short covering intraday rally to create, a slippery slope of hope for the market to continue to slide down. They sold it off. I mean, the NASDAQ got to up 30, 35 in the last half hour. The Dow was only down about 120, and then it just rolled over, and we closed down about 250, and the NASDAQ couldn't even hold the black. Transports, again, down. Most of these stocks really beaten up. Some of the most heavily shorted stocks had intraday rallies, some of the tech stocks, the biotechs. Again, classic hallmarks of short covering rally. You don't make a bottom on short covering rallies. You make a bottom on capitulation, on the long throwing in the towel. I heard a statistic that we made today the most 52-week lows in any month since November of 2008. I mean, that was the depth of the market meltdown. The Lehman bankruptcy, Fannie and Freddie going bankrupt, TARP failing, all that stuff happening. And this is just like that day. In fact, point-wise, here's another statistic, and maybe based on the close, maybe that's not the case, I'm not sure. But certainly earlier in the day, they were saying on CNBC that this is the biggest monthly point drop in the history of the stock market. So it's not just the worst January. It's the worst month of any year ever. Now, of course, it's not the biggest percentage-wise, right? Because the Dow is a lot higher now, so the point drops aren't as big. But I think they said it was the 9th biggest percentage decline in 1 month in history. And, of course, the month is only 2/3 over. So we still have, another third of this month to break that record. But, the market has got to be telling us that not only are we in a bear market, but we are in a recession. The market is forward-looking, right? The market is telling us that we're in a recession. In fact, the bond market is telling us. I was watching today on CNBC, Jamie Dimon came on, and he was talking about why he saw value in the high-yield bond market. And he's looking at the spreads between high-yield and treasuries, and he's saying, look, the high-yield market is priced as if we were in a severe recession. And so, therefore, this is a great bargain because we all know we're not only not in a severe recession, we're not even in a recession at all. Oh, the economy is going to grow 2 to 3% this year. Everything is great, yet the bonds are priced as if we were in a recession. Does it ever dawn on Jamie Dimon or anybody else that maybe the reason that the bond market is priced as if we were in a severe recession, it's because we are in a severe recession? I mean, then it makes sense, because why are the bonds priced as if we were in a severe recession? Because we are. All the data shows that, right? All the economic data that we keep getting, all that data says that we're in a severe recession. I keep talking about we get data points that we've never seen unless we're in a great recession. The market is behaving, the stock market is behaving as if something really bad is happening because we haven't seen action like this since 2008. Yet everybody is dismissing all of this evidence and saying, well, we're not in a recession. Look, if it walks like a recession, quacks like a recession, smells like a recession, it is a recession. We are back in recession, and nobody wants to admit that. Now, of course, there are people now saying, well, maybe the Fed is going to pause, or not even officially pause, but maybe be a little bit more slow before it raises interest rates again. I read this article, and this is kind of common of what's out there. This is in The Guardian. Janet Yellen and the Fed left with a face full of egg after interest rate rise blunder. And the tagline, the first line of the article says, 4 weeks and one market meltdown later, U.S. central bank's decision to opt for early rate hike no longer looks so clever. I mean, first of all, early rate hike? Rates have been at zero for 7 years. How can raising rates after 7 years of zero be considered raising them early? Look, the problem isn't that they raised rates early. It's that they raised them too late. Actually, scratch that. The real problem is that they lowered rates in the first place, which they never should have done. See, here was the problem. And I said this from the beginning. I'm not, Monday morning quarterbacking it. I said the minute the Fed made the mistake of bringing interest rates to zero and compounding it with quantitative easing, I said the minute they did that, they already had sealed their fate. The economy and the market were doomed. No matter when they raised rates, it was going to be a disaster. And the longer they waited, the bigger the disaster. So had they raised rates a couple of years ago, it would have been a disaster, just smaller than the one we're going to have now. And had they not done it in December, had they waited another year, then it would be even worse. So to say that they were early, that's ridiculous. What is ridiculous is that they believed that they could raise rates after having left them at zero for so long, and that it wouldn't matter, that everything would be fine. Right? Because again, the narrative that everybody's been selling, Ben Bernanke's got his book out there, Courage to Act, right? We saved the economy. Everything is great because of what the Fed did. And now, we could raise rates and shrink our balance sheet because everything is great. It's not, it's a disaster. The economy is in much worse shape today than it was 7 years ago. That's what nobody seems to understand. They still believe that the Fed cured us. Instead, their poisonous cure made us sicker than ever. That is what I wrote in Crash Proof. I wrote when I forecast that the bursting of the real estate bubble and the Great Recession and financial crisis, I said the economy could withstand that. What was going to kill it was not that disease, but the Fed's cure. And the Fed came up with exactly the cure that I was afraid they would, that I warned they would, and it's having the exact effect. This is what's going to kill the economy. Now, of course, the Fed is going to try it again. I still believe that the Fed is going to take interest rates to negative, and they're going to launch QE4. And it's going to be bigger than QE1, 2, and 3. But it's going to be too late to stop this recession from unfolding, which again will be deeper and longer lasting than the last one. But I think at this point, it's going to be a lethal dose of monetary stimulus, and it's going to be lethal for the dollar. And of course, the dollar is still rising based on this idea that the Fed is going to keep on tightening. And this is causing turmoil throughout the world where people have pegs to the U.S. dollar or people have lots of debt denominated in U.S. dollars. The fact of the matter is the dollar is massively overvalued. We have huge trade deficits. We have huge budget deficits. The dollar should be much lower. The fact that it's not is what's screwing up everything. And the fact that everybody believes that this overvalued currency is going to keep going higher, this is what is wreaking havoc throughout the global economy. But what's amazing to me is people still don't see that all these rate hikes can't happen because the Fed or the U.S. economy is the economy that is most vulnerable to higher interest rates. We are the biggest debtors. A U.S. recovery and higher interest rates cannot coexist people still haven't figured that out yet. So this dynamic is going to continue. You know, gold prices are rising. Gold was up another 15 bucks or so today. We closed about 11.02. We were up about 22 bucks on the highs. But interestingly enough, yesterday, even though gold prices were flat, gold stocks collapsed again to new record lows. I mean, the XAU yesterday was at the lowest ever in the history of the index. I think it, maybe goes back to the 1980s. And even though gold was up big today, gold stocks were up, but they didn't even recover, I don't think, half of what they lost yesterday. So gold stocks as a group are down about 10% since the Fed raised rates, even though gold is up 3-4% since the Fed raised rates, because it's still denial. I mean, the only gold stocks that are going up are the ones in South Africa. They've been going up because the rand's been killed. And so that is increasing the profitability of mining for gold in South Africa. But the same story is happening in Canada or Australia, just on a smaller scale. But I think these South African stocks are ultimately going to lead the way higher for the rest of the group. But right now, there's just a big shakeout. There's probably redemptions, margin calls, hedge funds blowing up. Who knows? It's all like 2008. And remember, the dollar was strengthening all through that financial crisis until the Federal Reserve finally admitted there was a problem. And once they stimulated and launched QE1, the dollar tanked. It lost almost the entirety of its rise. The only difference is when the dollar rose in 2008, it rose from the floor. It had been falling for 7 years to a record low. This time the dollar is rising, I think, as the final push of a rally that began almost 4 years ago. And so I think when the dollar reverses this time, it's going to go down for the count. The only thing that the bulls seem to have left to hang their hat on, I'm not talking about stock market bulls, but the economic bulls, is the jobs numbers, right? Because that's what it keeps boiling down to. I keep hearing, well, the consumer's in great shape. Why? Why do people think the consumer's in such great shape? I mean, yes, gas prices are going down, but I mean, lots of other things are gone up. I mean, health insurance has gone up. Rents have gone up. So if you add what you pay for health insurance and what you pay for rent, I mean, you pay a lot more for those than you do for gasoline. I mean, so yeah, I mean, gas is a little cheaper, but the cost of living is going up, despite the fact that gas is cheaper. Of course, a lot of people that don't have jobs, they don't drive very much anyway, but they still pay rent. They still, so these costs are in fact going up. So the whole myth that the consumer is in great shape, despite the fact that retail sales are collapsing, and we just had the worst Christmas since 2008. The idea is, well, the consumer is in good shape because we have full employment. We got all these jobs. We don't have full employment. I mean, the labor market has never been this weak. I want to go back again and talk a little bit more about that non-farm payroll number we got for December. 292,000 jobs was the number that came out. And everybody was so excited about that number. Let me give you a little bit more of the details of that number. First of all, only 16% of those jobs went to people who were over 24 but under 55. Right? Those are the main people that need jobs. Right? And only 16% are in that group. So 84% of the jobs went to people under 24 or over 55. Now, what does that tell you? That tells you that they hired a lot of people, maybe to gift wrap presents. They hired a bunch of Santa Clauses for the department stores. These were not real jobs. And in fact, the percentage of the jobs that were created in December that went to people who already had a job, at least one, they might have had two, but they already had a job, 64%. 64% of the jobs created went to people who already were employed. That is a 10-month high. The number of people who got their first job, right, who didn't have any job and got a job, whether it's a part-time job or a full-time job, they just landed a job. They were unemployed and they got a job. That was at a 3-month low. And here's another fact I didn't even know about until I read this. The government counts any part-time job that you have as long as you have enough part-time jobs to equal 35 hours a week. So let's say a guy lost his job. He had a good job. He had one job and he lost that job, right? And so now he's hobbling together a living. He's got 3 part-time jobs now, where collectively, if you add up all the hours on those 3 part-time jobs, he's working 34 hours a week on all 3 jobs. But they're all low-paying jobs, minimum wage type jobs. So even though he's working full-time hours with those 3 jobs, He's making less money than he made when he had one job. Since you have 3 part-time jobs that equal 35 hours a week, the government counts all 3 of those jobs as full-time. I'm not making this up. So that means that by destroying one full-time job and causing 3 part-time jobs to be created to replace it, Obama can get credit for adding 2 full-time jobs to the economy. See, the only time a part-time job counts as a part-time job is if you only have one, or you have 2, but they don't quite add up to 35 hours a week, which is absolutely ridiculous. So that is why the labor market seems so strong, because we have so many people who are forced to take second and third jobs. Now, that is not a sign of a strong economy. I mean, most people don't want 2 or 3 jobs. They want one. In fact, a lot of people don't even want one, right? A lot of these jobs for people who are 55 and older, they want to be retired. They want to be on the beach. They want to be playing golf or shuffleboard or pinochle or whatever they do, or visiting their grandkids. They don't want to be working at Walmart. Why are they there? They're not glad that they're back in the labor market. It's because they have to afford the rising cost of living. So this supposed proof that the consumer's in great shape and the economy is great is a mirage. It's all a lie. And all that has to happen is the jobs numbers have to roll over. Because clearly, if we are in a recession, and it looks like we are, based on all the economic data and all the market data, then employers are going to lay people off. Because remember, all these employers were expecting this robust recovery because that's what they've been told. That's what their economists have told them. That's what the government has told them. That's what Wall Street has told them. And of course, a lot of employers, small employers, maybe they had money in the stock market and their statements were going up. And so, things must be good, right? My stock portfolio is going up. Everything is great. Alan Greenspan, Ben Bernanke's on the cover of magazines. He's our hero. And so, they bought into this. And so they hired people, or they hired part-time people, whatever they were doing. But now they get surprised. We're in a recession. The market's in a bear market. The fact that the Fed could put so much stock in the wealth effect, but not even acknowledge the reverse wealth effect, a lot of wealth, about $2 trillion has been wiped out from the decline in the S&P just this year. $2 trillion up in smoke in January. That doesn't mean anything? That doesn't do anything? Of course, especially when you have a recovery of the stock market, by the stock market, for the stock market. The whole recovery was built, right, on a foundation of the wealth effect from bubbles in stocks and real estate and bonds or whatever. And of course, the real estate market is rolling over. We got new home starts out today that were very disappointing. And of course, this was in the month of December. And it was a very, very warm December. So you would have thought that there would have been even extra building starts in December. People would have taken advantage of the lack of cold weather in December. They didn't do that. But of course, I think the numbers are going to be much worse now in January, February. And of course, if the economy was so bad, and JP Morgan has already got their forecast for fourth quarter GDP down to 0.1. 0.1. I mean, they're basically at zero, right? But if the fourth quarter of last year was so weak before the stock market collapsed, imagine what's going to happen to the first quarter when you have to take all the weak economic data that we had at the end of last year and combine that with what's happening in the stock markets this year. And again, they're still trying to blame this on oil prices, which continue to fall. Now, we're down below $28 a barrel, but oil is not causing. Look, oil prices went from $150 a barrel down to $35 a barrel in 2008. It was a bigger decline than this, right? Because we started from 150, not 100, right? So that was a bigger decline. Yet nobody blamed the 2008 meltdown on the falling oil price. But that's what they're blaming this on, or they're blaming it on China. But the problems in China have to do with the Chinese currency, or in Hong Kong with the Hong Kong dollar, because everybody thinks they're going to have to break their peg. Why would they have to break their peg? Well, because the dollar's going to go up. Well, why should the currency of the world's biggest debtor go up? Why should the currency of a country that's back in a huge recession go up? Because people are in denial. They just think the Fed's going to keep on raising rates in a vacuum. How can they do that? Especially since this is an election year. Look, do they just want to hand the White House to Donald Trump, who looks like he could very easily be the Republican nominee? But Hillary Clinton has no chance if Janet Yellen does nothing and just allows this whole recession to unfold. Because if this is the type of recession I think it is, we will still be in this recession in November when people go to vote. And the stock market may have surrendered all of the gains from 2009. So Barack Obama's whole claim to fame is that he inherited a mess and now everything is great. And Hillary Clinton wants to wrap herself up in that, right? And say, me too. See, I vote for me because it's more of Obama, because everything is great. And I'm going to, I was part of that administration. Well, she doesn't have that. If we're right back in recession, if Obama's like, well, I inherited a mess and now I'm leaving an even bigger mess, he's not going to be leaving it for Hillary Clinton, because it's going to be just like John McCain all over again. The Democratic nominee will have no chance of getting elected if it's a complete meltdown. And all Obama wants to do and Hillary Clinton wants to do is talk about how great things are. The only chance they have is to acknowledge the problem, but blame it on Wall Street again, blame it on lack of regulation, blame it on something going on in China. Who knows what they're going to blame it on? They're not going to accept responsibility. The Fed's not going to accept responsibility, but they're going to have to find a scapegoat, because they're going to have a reason that's palatable to lower interest rates to negative and to launch QE4. And again, as I said before, that's not even going to be it. They're not going to stop there. They're going to do real old-fashioned priming the pump, Keynesian stimulus. Paul Krugman is going to finally approve of what we're doing, because they're going to increase government spending. They're going to come up with what kind of make-work gimmicks, and they're probably going to have some middle-class tax cuts, and it's going to be a bonanza of deficit spending. I think we can end up with a $2 trillion a year budget deficit, not just $1 trillion. This is what's coming, and the question is when? How much longer can they be in denial? Remember, it didn't end in 2008. You had Jim Cramer on CNBC screaming that the Fed knows nothing, they know nothing. When are they going to come in? Well, they still know nothing. They shouldn't have come in back in 2008. They should have allowed the market to fix the problem. But why should they? Because they created the problem. The last thing they wanted it was solved, because that solution would be painful and it would ultimately reveal that they were the cause. So what they did is more of the same, gave us an even bigger bubble, which they just pricked. But again, even if they didn't prick it, the air was seeping out anyway. And again, I thought they would have been smart enough to recognize this and find an excuse not to raise rates. But I overestimated the intelligence of the Fed. Once again, they believed their own press clippings. Maybe they actually thought that they had finessed this, that they had actually found an exit strategy from a position where there is no exit. I mean, that's why I said they were in a monetary roach motel. I meant that for a reason. I said there would be more QE than Rocky movies for a reason. Ray Dalio from Bridgewater was on CNBC Today too, out in Davos. They're having the big economic conference there that they've never invited me to. And he's predicting now QE4. And, he's been doing that for a little while now. But, of course, no one's been predicting QE4 as long as I have, because I predicted it when they launched the very first QE. I knew it was a never-ending process. People are acting like, oh, well, now they're going to have to do it. It's inevitable. The minute they did QE3, QE4 was inevitable. Right? The minute they do QE4, QE5 is inevitable until the dollar crashes. And, of course, once the dollar collapses, well, then, again, we die of the overdose. And so QE4 could be the end of it. You'll see if the dollar completely melts down, and if the government finally figures out or admits what they've done wrong and we actually take a different path. Well, if not, well, then QE5. But now you've got more people saying it. And it's not just Dalio. There's some other people now that are talking about it. But they weren't talking about it 6 months ago or a year ago. They're only talking about it now because all this bad stuff has happened. And so now the Fed has to come to our rescue. Well, the only reason the bad stuff is happening is because the Fed came to our rescue. Because they didn't actually rescue us. We're drowning, and they didn't really throw us a lifesaver. They threw us an anchor, and we just didn't realize what it was that we were holding in our hands. And now everybody is saying, oh, yeah, we need that anchor again. Yeah, we need it like a hole in the head. But unfortunately, that is what we're going to get. But fortunately for, my investment thesis, it seems like everything that I've been forecasting is either already occurred or in the process of occurring. The one thing that hasn't happened is the dollar. And here's why. I mean, everybody is staring at this recession, and we're staring at a bear market, and nobody wants to admit it, right? It's like It's like the old fable about the emperor and his new clothes. Like, we're all looking at the emperor, and everybody sees he's naked, but nobody wants to admit it, right? Nobody wants to say the guy's got no clothes. We're all just looking at this guy butt naked, and we're admiring his clothes. And everybody's waiting for Janet Yellen, who's, the little boy, now she's a little girl. She's got to come out and say, he's naked, right? And until Janet Yellen admits what should be obvious, nobody is going to acknowledge it. But at some point, she is going to have to. And when she does, it is a huge game changer for the dollar, for the commodities markets, for gold. And then I believe my investment thesis will be vindicated, because I believe my economic thesis already has. It's just a question of time before all the people who have been in denial for all these years finally admit that they were wrong.
There's so much factually incorrect information and underreporting by legacy media today. Shouldn't there be truth in media? Well, there is. Truth in Media. Recently, a novel thought is now a reality with truthinmedia.com. Led by award-winning journalist Ben Swann, truthinmedia.com is the source for uninfluenced, reliable, fearless news, where journalists pursue real questions, not conspiracies. Make truthinmedia.com your default browser's homepage today and get breaking news and commentary that speaks the truth to power. It's also where you can tune into the Peter Schiff Show every week. Visit truthinmedia.com today. That's truthinmedia.com. Access to Truth in Media RSS feed by visiting truthinmedia.com/feed. Attention listeners, I have an urgent message for you. We're in the middle of a war. The global conflict is destroying the lives of millions without a single bomb being dropped. It's called the International Currency War, and your bank account has been drafted to fight. The victims in this conflict are our currencies, the dollar, the euro, the yen, the pound. They are all heading to zero as irresponsible central banks compete to see who can print the most the fastest. But there's one form of money politicians and central banks can't destroy: gold. Today, it's more important than ever to understand the value of gold in your portfolio and to keep a close eye on major market developments. Subscribe to my monthly video cast and you'll be the first to hear my latest analysis on gold investing and the currency wars. Visit goldvideocast.com right now to subscribe for free. I call the dot-com bust, then the housing bust, and I advise clients to diversify into foreign equities and hard assets while the rest of Wall Street laughed at me. Now I want to keep you up to date on the next crisis that is brewing. My Gold Videocast also includes personal interviews I've conducted with other contrarian investors like Jim Rickards and Axel Merck. Gold has gone up 256% since 2003, but it has a lot further to go. Don't miss the rally. You can prosper during this time of currency wars, but only if you stay educated. Get a free subscription to my Gold Videocast at goldvideocast.com. That's goldvideocast.com.